All right, let's go. Week two. Week two of my little vlog. Let's go Portland. I was at some holiday parties this weekend, and apparently people are actually watching this. I can't believe it. Today, let's just dig right in. I'm gonna talk about home prices. There's so many things being said about home prices, and I want to give you a little perspective. Let's go right into the share screen. I want to give you a little bit of context before I hop in. I want to give you the annual look at home prices. I want to give you the month over month look at home prices. And typically, people talk about home price appreciation and they speak to it in an annual way. But when we get in a market like this and war is being waged in the media, we start to look about it on a monthly basis. And so let's get educated on both those topics. I want to give you some good graphics that you can think about. It helps kind of conceptualize everything. And I would recommend that if you have people that like to debate this, tag them in the comments and tell them to watch this, and maybe they can learn. Everybody's got that really super smart uncle that knows everything about everything. So just let me be the educator. All right. Let me show them what I got. And let's start off right now with a quote from the FHFA. Huge government entity tracks everything mortgages. The rate of US house price growth has substantially decelerated. This deceleration is widespread, with about 1/3 of all states and metropolitan statistical areas registering annual growth below 10%. So they're saying states and then metropolitan statistical areas. So for that, think of like radio station coverage, right? It's not just a town, but an entire area. And 1/3 of those states areas are registering annual growth below 10%. And if you think about it, that means that 2/3 are above 10%. And even 10% home price appreciation is very, very good, well above the average. But there's no doubt, right, that we're in a time period, and we've been for several months, of deceleration. Less appreciation, less momentum in the market, all due to one thing, and that is the rapid rise in interest rates. And I talked about that a little bit last week. If you didn't watch the video, go ahead and watch it. But if we look at September, the most recent numbers that are published, this comes out from the FHFA, from CoreLogic, another great entity from Case-Shiller. Not one of my favorites, but it's often quoted, so we'll put it up there. We have 11%, 11.4, 10%, 10.6% appreciation in this country. Now, look, I know September's in the rearview mirror, but this is the most recent data that was published as of the end of November. New data doesn't come out until December, and that'll still be lagging by a couple months. But this is what we've seen. This appreciation is, honestly, it's an anomaly in the real estate market. It's been a lot. Let's take a look at this anomaly graphically. This is from CoreLogic. You can see it right down there. Going all the way back to January of last year, it shows a rise up in residential home price appreciation, and now this deceleration. By the way, this is off closed sale prices. This has nothing to do with the pie in the sky list prices that you see out on maybe the Zillow or the Redfin websites, where somebody comes on the market and puts their $300,000 house on for $1 million expecting to get it. So these are closed sale prices. And sorry, I digress, but I always like to remind people that the historical average for home price appreciation in this country is 3.8%. See this little orange bar on the left? And let's see here. You see I've drawn a little dotted line there. Some of the entities out there, they're calling for depreciation this year. Some are calling for marginal appreciation going into 2023. And I'll give you a little bit of a teaser. All right. I don't like to do forecasts, but I'm going to try to do one. I got a lot of data. I'm going to try to do it right after, we celebrate Christmas. We're going to do it right after Christmas. And, hopefully you watch it. Right. I honestly, I had a number of people come up to me and start telling me they were watching these. I really appreciate that. It makes my job easier. So, okay. If you look at the peak of the market, happening in April, spring of this year, and then you see that deceleration ever since then. We have less appreciation annualized in the real estate business, but this is still 16% year over year, 14% year over year, 13% year over year, right? In these type of markets, when we see this deceleration, people want to talk about it on a monthly basis. So they're looking at what that price was, from August to September. So let's take a look at month over month appreciation. Here it is. And the question I would sort of put out there is, have home values hit bottom in the market? So we start with January, and this comes from Black Knight. Great source of information, very reliable, very well known. It was actually quoted in that article that we mentioned, of the Diana Olick article last week. This shows month over month appreciation or depreciation in the national real estate market. So January, February, March, April, we're seeing through June appreciation in the market, and then a slight dip month over month in July, August, September. And we'll see what comes out for October and November. We're going to watch that. We could see a little further dip. We could see it level out. But what we do, we do know that interest rates hit as high as 7.5% that second week in November. That was exciting. But the question we want to start to look at is what's happening now across the country. And I think it's going to be no doubt different depending on the area of the country or the city that you live in, right? Mark Fleming says it best. Mark Fleming, chief economist for First American, noted down here, house price appreciation has slowed in all 50 markets that we track, but the deceleration is generally more dramatic in areas that experience the strongest peak inflation with appreciation rates. So the areas that experience the strongest run-up in prices are starting to see more pronounced decreases in prices right now. Parts of Phoenix like that. Some of those condo markets are like that. But if we look at this from a month over month basis, I'm going to kind of give you, the Case-Shiller look here real quick. And the most recent numbers of September, we're seeing negative depreciation across the markets. Now a slight depreciation in some of these markets. I've highlighted in red where it's over 2% depreciation in Dallas, Denver, Las Vegas, some of the West Coast markets, Phoenix, San Diego, San Francisco, Seattle, no doubt are seeing that. But okay, so what does that mean for us in Portland? Look, Portland looks pretty healthy, but we do see, trends nationally that ultimately, kind of lead to the health of the market. So what's become interesting is if we look at home price movement in the last 2 months at some of the hardest hit markets, I'll show those to you. Here we go. Yep. That's right. San Diego, San Francisco, Seattle, these West Coast markets, where they were last month, and then what's been most recently published this month. This is through the end of November from Case-Shiller. In each one of those markets, we saw less depreciation. So this was post-interest rate peak, and we're seeing that start to tick down. So take San Diego. My brother-in-law, Nick, is down there. For example, the month prior, minus 2.8%. This month, minus 2.1%. Although slight, but less, you'll see that trend in each market. That's very interesting. I'm not ready to like call, a bottom. It's not my job, but I'm looking at these numbers and I see a trend. We got to pay attention to it, watch the home price moving across the country. We can draw conclusions from that. In 20 years, there's no doubt that this is one of the most volatile markets I've ever seen. The volatility happening so rapidly. But we've seen a little bit of relief in interest rates. There's some good news that came out about inflation. The jobs report came out a couple weeks ago. It was a little stronger than what the Fed would like. But right now, the average year fixed mortgage is about 6.1%. That's running out of Remax Equity, or I'm sorry, Equity Home Mortgage. Work with Johan Nielsen over there. We were looking at 6.1% with no points. Obviously, those rates are so hard to quote for everybody. It's different, depending on credit and down payment and purchase and refi. But, using apples for how Freddie Mac quotes them, that's what we're looking at. And it's way too early to see if we're out of the woods yet, by any stretch of the imagination. But here's what Craig Lazara says from the S&P. As the Federal Reserve continues to move interest rates higher, mortgage financing continues to be more expensive and housing becomes less affordable. Given the continuing prospects for a challenging macroeconomic environment, home prices may well continue to weaken. So what's he talking about there? He's only talking about one thing, and he's talking about inflation. And what the Fed is doing is raising the federal funds rate to combat inflation. And I don't want to debate whether or not that's the right tool. They have other tools. But whether or not that's the right tool, that's what they're using. Everybody says it's the only tool, but it's not. They have other tools. And going, this December, they met again, and they had the previous 4 Fed rate hikes were 0.75%. They toned that down. They took it down to 0.5%, 0.5. And at that time when they met, the mortgage rates were 6.49%. And now we're at 6.1. So what the Fed does with the Fed funds rate does not directly impact mortgages, but it does kind of on a secondary level, right? And one of the reasons why I feel like our interest rates have kind of topped out and they're going to start tapering down is because when the Fed raised those Fed funds rate, we saw relief in mortgage rates. We saw a rally in the bond markets. People started buying bonds, long-term debts, mortgage-backed securities. Mortgage rates went down. Now, some of these entities regarding home prices are, calling for depreciation. Some are calling for appreciation. And I like to track these entities. But let's put this into perspective. Let's kind of go worst case scenario. Okay, let's back it off. If prices were to drop by a certain amount, this is where things get really interesting. Prices were to drop by 5%. That puts us back to February of this year. If prices were to drop by 10%, October of 2021, 15% June 2021, 20% February 2021, 25% puts us back almost exactly 2 years. That run up was so big, it built a lot of equity in the market. We got a lot of room to go. Now, I don't think anybody's calling for a 25% decline in prices. I am not even remotely close. But I want people to understand that if they did buy a home in the last few years, they did make a wise decision because these things swing. Every time you look at these charts run up, they run down. Then they run up, then they run down. It's the way of the markets. That sounds like Star Wars, kind of. Let me give you one last slide before I wrap this up. I got a lot to say. I'm sorry. Let's take a look at home. Actually, I'm not sorry. I'm really excited about it. Let's take a look at home price appreciation pre and post pandemic, depending on the city that you're in. This is a great perspective on home prices and where we're at right now. And to kind of show you, hey, here's what the run up looked like during the pandemic. And here's what it looked like prior to that from 2017 to 2020, the start of the pandemic. Just to give you a little bit of perspective and to give you, you know, information on how to think about this. And like I said, I'm going to try to do some forecasting. I'll try to do that next week after the holiday break. But what I want to show you here is, hey, I think we're in pretty good position. All right, take a look at Portland, for example. In those 3 years, we saw about 11% run up. And then during the pandemic, when everybody and their mom had to buy a house, we saw a 32% run up in pricing. That's not sustainable. That ate away at our affordability. It made it really difficult. We had to have a little bit of a reset, and we need to return to around that 3.8% number at some point. Really important to note, though, averages are made up of extremes. 3.8%, we might see negative 3.8% 1 month or 1 year. We might see 7% the next year. We might see negative 1% 1 year. And we're going to end up averaging out at that 3.8. So again, if you buy a $575,000 house and you average 3.8% appreciation over 3 years, you're going to have a $643,000 house at the end of those 3 years. You can build a lot of wealth, generational wealth through home ownership. Here's the last slide. I lied. This is really the last slide. So if you're watching this on Instagram, click on my bio, go into my link tree, and you can download the winner buyer, winner seller guides. They're out there. They're littered with great information. Get in contact with me. If you have a friend that you think should talk with me about real estate, tag them in the comments. This is going to be up on YouTube. You can follow that channel too. I mean, why the heck not? Let's just build this. So in a couple weeks, look for my forecast. Still kind of scared because forecasts are usually only good for about 3 weeks. But heck, man, let's do it. And thanks for watching, and hope to hear from everybody really soon. Thanks.